The TSX Composite closed higher on Thursday, carried by oil price momentum and a wave of big tech earnings out of Wall Street. Enbridge hit a new 52-week high. Canadian National Railway drew fresh upgrades from RBC and Citigroup. The loonie posted its biggest monthly advance in a year, up 2.2% against the US dollar, as investors bet that higher oil prices would eventually push the Bank of Canada toward rate hikes. On the surface, a straightforward rally built on commodity strength and index momentum. But buried in the day's news was something that had nothing to do with any of that. Canada was officially selected as the host nation of the Defence, Security and Resilience Bank, a new multinational institution backed by 19 founding countries. The final negotiating round concluded in Montreal on Wednesday. The Globe and Mail reported the decision, noting that the other 18 founding countries have not been publicly disclosed. Britain and Germany, two countries that would seem the obvious anchors for a European defense finance institution, reportedly declined to join. Canada got the bank. The question is what that actually means. The Defense, Security and Resilience Bank is not the IMF. It is not the World Bank. It does not yet have a disclosed capital base, a published mandate, or a list of member states beyond the 19 founding signatories. Critics cited in coverage pointed to existing NATO-adjacent financing vehicles, the Security Action for Europe initiative among them, and questioned whether a new institution is necessary at all. That skepticism is reasonable, but it misses the specific mechanism that makes host nation status financially meaningful. When a multilateral financial institution is headquartered in a country, that country becomes the de facto jurisdiction for its bond issuances, its procurement contracts, its staffing, and its regulatory charter. The Bank for International Settlements sits in Basel. The European Stability Mechanism operates out of Luxembourg. These are not accidents of geography. They are structural capital advantages that compound over decades. Host nations receive preferred creditor treatment in disputes, attract a permanent professional class of international finance workers, and sit at the center of deal flow that other member nations route through the host's legal system. Canada just negotiated that position for a defense finance institution at the precise moment that global defense budgets are expanding at the fastest rate since the Cold War. European NATO members committed to raising defense spending to 2% of GDP. Many are now targeting 3%. The capital to fund that spending has to be intermediated somewhere. Montreal, where the final negotiations concluded, now has a claim on that infrastructure. There is a condition attached to all of this, however. The bank does not yet have a confirmed capital structure. If founding members contribute symbolic amounts, the institution remains symbolic. The critical benchmark is whether the 19 nations, particularly any undisclosed G7 members, commit meaningful subscribed capital in the bank's inaugural financing round. The parallel running alongside this development is worth noting. On the same day, a report outlined Canada's potential for a $200 billion clean energy boom, contingent on faster regulatory approvals. SHEL's $22 billion acquisition of ARC Resources, announced earlier this week, was framed by analysts as a vote of confidence in Prime Minister Carney's fast-track approval agenda. Trump signed an executive order authorizing the Bridger pipeline from Canada to Wyoming, partially reviving the Keystone XL corridor. Multiple large institutional bets on Canadian energy infrastructure landed within a 72-hour window. The Defense, Security and Resilience Bank fits this pattern. Canada is being selected repeatedly as the jurisdiction of choice for large institutional mandates: energy, finance, now defense. The consistency is not coincidental. Carney's government has signaled a deliberate pivot: faster approvals, expanded hydrocarbon export infrastructure, and active positioning for multilateral institutions that carry long-term capital flow implications. The near-term evidence for this thesis holds as long as two conditions remain intact. First, the founding members of the Defense Bank must proceed to a capital commitment, the bank moving from announced to capitalized. Second, Carney's approval acceleration agenda must survive domestic fiscal pressure. His spring economic update is expected within weeks, and opposition critics have already framed his fiscal path as a continuation of Trudeau-era deficits rather than a clean break. If the capital commitment materializes and the fiscal update presents a credible consolidation path, the institutional investment thesis for Canada strengthens considerably. If the bank stalls at the announcement stage, as multilateral institutions often do, and the fiscal update widens the deficit projection, the narrative reverts to one of ambition without execution. The Canadian dollar's 2.2% monthly gain, Enbridge at a 52-week high, SHEL's $22 billion bet, and now a defense bank mandate. They all point the same direction. Whether the capital follows the announcements is what the next 90 days will settle.